Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing my favorite company, and by the way, the first company I ever analyzed on this channel. I believe it was in September 24th. I analyzed Microsoft Corporation. And guys, since their earnings are coming out on Tuesday after market close, as well as a bunch of other companies, I put out a community post, guys, asking which ones would you like to see. This is not only for Tuesday, but pretty much this whole entire week. I put out a community post asking all of you guys which companies you guys would like me to analyze. It doesn't have to be just for Tuesday. It could be for the entirety of the week. There are a lot of them. I do have a plan to do some of them here and there, but if you guys want me to prioritize one over the other, you guys can go to that community post and vote on which company you would like to see, as well as if one isn't mentioned there, you guys can comment for the ones that you want to see. But regardless, guys, we're going to be analyzing today Microsoft, my favorite company, and for several reasons, and I will get into it in this video. So with that said, let's get started with this analysis. Now, before we actually get started, guys, I would like to tell all of you guys a really quick story of the relationship that I have with this company. Now, for all those of you guys who have not seen my first investment portfolio video that I made a couple of weeks ago, make sure to check that out. But essentially in that video, guys, I said, I started investing back when I was 21, and it was with Robinhood, and I didn't know exactly what I was doing. And at the time, guys, I did invest into the company Microsoft. Now, back when I was 21, it was around February 2016. And as you can see here by this chart, guys, Microsoft's share price back at this time was $51.56. Now, if you guys see that video, you can see that there's a lot of red in that first investment portfolio because I didn't know what I was doing. I was playing with options, losing money left and right. It was insane. And in retrospect, if I would have not done that, and if I would have actually implemented just a buy and hold strategy, not even a dividend strategy, just a buy and hold strategy, guys, and I've actually would have put in $1,000 when Microsoft was at around like the $56 range. Well, we can actually do the quick math right now. So like at $1,000, right, we divide this by 56, this would have bought me, guys, 17.85 shares. And if we actually take a look at the 52-week high, which in this case, if I can try and find it over here, it was at around the whopping 343. Let's just bring it up to $350, right? $350. And if we see the difference of what the peak was as well as when I bought it, if we do 350, let's just say minus around 53, well, this is a difference, guys, of $297 times the number of shares that this bought me, which was around 17.85. Guys, that would have been a $5,301 gain, not including dividends for Microsoft alone. Yeah, that is only for $1,000. Now, obviously, guys, the current share price for Microsoft, it is 260, significantly down from their 52-week high. But nonetheless, guys, it just goes to show that when you don't know what you're doing, you tend to miss out and lose a lot of money. But that is just a quick story I like to share with all of you guys, just so that way y'all can see the relationship I have with this company. I am very salty the fact that I missed out on this great opportunity. So now with that said, let's get started with this analysis. We are going to start off with the dividend summary, guys. Microsoft does pay a dividend. It's a tiny dividend, but it's a pretty good nonetheless, right? Dividend yield of 0.95, which ends up being 62 cents per share for an annual payout of $2.48. Payout ratio is very, very good at 26.48%. Let's take a look at the payout ratio though in regards to the cash flow in just 1 second. Now, the 5-year CAGR is also pretty decent as well at 9.6%, and they've grown this dividend for 18 consecutive years. That's not too shabby. Now, their ex-dividend date, guys, is actually coming up, so this might actually be a good time, assuming that our calculations say, hey, you may want to buy this now, to buy into this company, because if you buy in before the ex-dividend date of August 17th, you will get the dividend payment on September 18th, and they pay, of course, their dividends quarterly. Coming now to the calculator, guys, we got the ticker symbol of MSFT for Microsoft. Market cap, guys, of almost $2 trillion. To be fair, this was actually a whole lot higher. As I said, the stock price has fallen a significant amount since its peak. And as you can see right here, the current PE, guys, is 27.16. So with this current share price of $260, it just goes to show that, it just goes to show that this was a lot higher just a couple months ago, right? In fact, they went from $349.67 at the peak to the low of $241, so about $100 difference. So this is just one instance that you can't just look at a company and say, oh, it'll always go up, it can't fall $100+, when in this case it actually did. Now we have rebounded back a little bit. However, guys, there's still a lot of volatility when it comes to tech companies, especially with the fact that the Fed keeps raising interest rates. That has a lot of impact when it comes to tech companies, because tech companies tend to take on a lot of debt in order to grow. But nonetheless, guys, aside from that, you can see that based off of their PE, their current share price is still very, very expensive. So let's take a look at other metrics, cash flow, to come up with a better representation of what we should be paying for this company based on future growth assumptions. Now, looking at this annual dividends per share of $2.48 in accordance to the amount of shares outstanding that they have, guys, this is an annual payout of almost $18.6 billion paid in dividends every single year. That is absolutely massive. But take a look at this though. Looking at their 5-year average free cash flow and then subtracting this $18.6 billion, they're still left with a whopping $22.1 billion left. And on top of that, looking at last year's free cash flow, they're left with $37.56 billion. That is insanity. The fact that they are able to pay out $18.6 billion and still have $22.1 billion in their 5-year average and $37.56 billion in their last year's is absolutely insane. In fact, this comes out to be, guys, a payout ratio on the last year's free cash flow of only 33.07%. Think about that, guys. 33.07%. And on the 5-year, this is a payout ratio of 45.65%. Significantly lower in both scenarios than what I like to buy it at, under 60%. This company just prints money at this point. Now let's take a look at some fundamentals, and spoiler alert, they are amazing. There's a reason why I love this company, right? Starting of course with the net income 5 years ago of $25.5 billion to 1 year ago of $61.3 billion. That is an increase, guys, of 140%. Really, really nice consistent increase. We had a little bit of a hiccup right here from 5 to 4 years ago. They went from from 25.5 billion to 16.6 billion. But 3 years ago, guys, they did a massive rebound to 39.24 billion. And even during COVID, they did even better, probably because everybody was staying at home, nobody was going out. So tech companies really did really good during COVID, right? So during COVID, they actually did 44.3 billion, and even last year they did even better to $61.3 billion. All in all, guys, this company is looking really, really solid when it comes to their net income. And now coming to the most important of the profit metrics, and that is none other than the free cash flow. Cash from operations less your capital expenditures. This is the one that companies use to pay for everything. They use it to buy back shares, to pay down debt, to issue a dividend, to grow the company, and of course to make acquisitions, which, by the way, Microsoft recently did. A couple months ago, Microsoft actually announced that they would be buying Activision Blizzard. And guys, this is what I mean by making acquisitions. Companies use this cash flow in order to do things like this, right? So it really does help to have positive free cash flow as well as increasing their cash flow as well. And well, you really don't miss that when it comes to Microsoft, because 5 years ago of $31.4 billion to 1 year ago of $56.1 billion, increase of 79%, with a 5-year average free cash flow of $40.6 billion. Nothing else much to say here, guys. This is amazing, consistently increasing year over year. And now looking at the revenue, guys, 5 years ago of $96.6 billion to 1 year ago of $168.1 billion, increase of 74.06%. Again, very, very similar to the free cash flow. Nice consistent increase. I like to call this the staircase increase, right? Because it's like slowly increasing year over year. It's really, really solid, really consistent, and it's exactly what you want to see when it comes to pretty much all of the profit metrics. They're all really, really solid. And now let's take a look at some balance sheet numbers in regards to the total assets and total liabilities. We do a difference of these two in order to see if the company's solvent, if when a recession hits, they'll be able to survive it. Essentially, guys, obviously you want this number to be positive, right? Because if it's negative, that means that their liabilities exceed their assets, and that's no good. But on top of that, you want it to be consistently increasing throughout the past 5 years as well. And currently they're at $163 billion in this difference, and within the past 5 years they have consistently increased this as well, except for 5 years ago to 4 years ago. They did go down by around $5 billion or so, but they quickly recovered that the following year. Now average total assets ends up being, look at this guys, $296 billion. Average liabilities is around $180 billion, and doing this difference we get around $116 billion. But now let's actually see the metric that we didn't have the couple times before we've analyzed this company, and that is the cash flow minus the total liabilities. As I said, cash flow is used to pay down their debt. So we're going to take the cash flow of every single year and subtract the liabilities from it, or in this case, add it, right? Because liabilities are already negative. So what you want to see here is their cash flow and liabilities to be getting closer and closer to zero. Essentially, their cash flow increasing much more than their liabilities are increasing. Now, this is actually fairly surprising because this is the first mega cap that I've actually analyzed using this one. So you can see it's remained roughly flat within the past 5 years, though beginning 3 years ago, they have been increasing it to closer and closer to zero ever since. Not by a huge amount, but it's still heading in the correct direction. But it's essentially, guys, a flat graph. So it's not bad, but it's not good either, right? If we take the average cash flow and then subtract the average liabilities, we get around negative $139 billion. And now looking at the metric that people tend to overlook, and that is the shares outstanding. Guys, I can't stress this enough. You have to look into this metric because this one tells you how much the company is diluting you as the investor, or if they're buying back shares, they're actually giving you a bigger piece of the company. Remember, when you buy a share, when you buy a stock, you are buying more than just a ticker symbol. You are buying a piece of a company, right? So the more shares that there are out there for that company, the less ownership of the company you have. You want the company to be buying back shares. And when it comes to Microsoft, this is no surprise that this is a good thing because they are buying back shares at a alright rate, right? 5 years ago of 7.7 billion shares to today, guys, of 7.5 billion shares. On the 5 year, this is a decrease of almost 3%, to be exact at 2.92%. And from the previous year to the current year, they bought back almost 0.5% of shares. This is looking at 1 year ago of 7.5 billion shares to today, as I said, 4.48 billion shares. So as it stands, guys, this is looking fairly good. They are buying back shares, not at a fast rate, but at a pretty consistent rate just by looking into this graph. And lastly, looking at the cash and equivalents, they currently have $12.5 billion in cash and equivalents with an average cash of around $11.9 billion. And now, guys, time to make some assumptions. Low, median, high, using, of course, the 3 different factors as always: revenue growth, the projected share buyback, and the required rate of return, which I like to keep flat at 10% to match the S&P 500. So of course, with the revenue growth, guys, let's come over here to Seeking Alpha and see that the revenue growth forward is actually 16.43, while the revenue growth year over year has been 20.37%. So my job as an investor is to be conservative when it comes to these assumptions. I have to take into account every possible scenario, especially the fact that the Fed is raising interest rates, as well as the possibility of an incoming recession. So I have to take this into account, and in doing that, I'm going to put the revenue growth for the low assumption at around 12%. For the median assumption, let's say 15%, and for the high assumption, let's say 18%. Now for the projected share buyback. Well, we just saw the shares outstanding, that they have been buying back shares within the past 5 years at around 3% or so, right? So let's take this into account. For the low assumption, let's say at 1% within the next 4 years. For the median assumption, let's say 2%. And for the high assumption, let's say around 3%. So now with this, guys, we actually have the target share prices, not adjusting for debt, as well as adjusting for debt. So for the low assumption, not adjusting for debt, we get around $146.04. For the median assumption, it is $162.59. And for the highest assumption, it is $180.64. Now we need to adjust for debt. And the way we do this is we take the cash and equivalents, we add the net debt, if they have more debt than cash, then this number comes down, and if they have more cash than debt, then this number comes up. So you can see it does come up by a huge margin, right? More than $100, which is just insane. For the lowest assumption, this puts me now at $293.76. For the median assumption, it is $326.88. And for the highest assumption, it is $363 on the dot. Now, on top of this target share price adjusting for debt, guys, let's do a 5, 10, and 15%. So that way we take into account every possible scenario that might actually go wrong on top of this target share price after debt, right? So we're really being really conservative when it comes to this. And in doing so, this puts me between the range of $249.70 to $279.07 for the low assumption. For the mini assumption, it is $277.84 to $310.53. And for the highest assumption, guys, it is $308.55 to $344.85. Guys, the current share price is $260. Now, if you actually take a look at these target share prices, you can pretty much just see that when it comes to them after debt, it is an all-out buy except for the highest margin of safety for the lowest assumption. Aside from that, it is pretty much an all-out buy in everything else. Now, when it comes to the target share prices not adjusting for debt, well, we still would want to wait for this thing to fall a little bit more. But I do have to tell you guys something important when it comes to these target share prices after debt, and that is the fact that, well, Microsoft's current net debt, it is at a negative $26.7 billion. Guys, that is essentially why this share price is that high when we adjust for debt. It's because their net debt is already in the negatives, right? So this is where you would have to make your own assumptions for starters, because none of this is financial advice. And of course, since every investment is the present value of all future cash flow, you guys should make your determination as to what you would think this company will grow in the future, as well as their projected share buyback. Because by changing any of these numbers, everything can change drastically, like in a pinch, right? So for example, let's say that for the lowest assumption, you think that they'll actually grow at around 5%, and you think that they'll issue shares at negative 5%. Keeping the same required rate of return the same, guys, well, there you go. Now the target share prices have fallen even more, and the target share prices after debt is telling you that you will still have to wait for you to buy it. So everything is the present value of all future cash flow. That's why, guys, as I say in every single video, I have this calculator available for free. Anybody could have it. Please have it for free. I give this one out because this is not financial advice. I want you guys to be using your own assumptions, because I don't know your financial situation. I don't necessarily know what you might think this company might go into the future either, right? Based off of mine, this is essentially where this puts me at, but you guys should be making your own assumptions regardless. I also have, guys, a book value calculator, as well as a reevaluation calculator and a dividend tracking sheet. If you guys want to track Microsoft, by all means do it. You can track it here. I have videos on how to set all of them up. It's in my calculators playlist. There's a link in the description to all the calculators in regards to each specific video. Just make sure you go onto that and you do that, right? This is not financial advice, guys, as I said. So all I'm asking for in return for these free calculators is just please help me grow my channel. Like, subscribe, comment. That's about it. I'm giving you guys free stuff in return. Just give me 2 seconds of your time to give me something free in return back. Thank you so much for those of you who have subscribed, and I really am glad that all of you guys have subscribed and are enjoying my content. And that's why I'm more than happy to invest in YouTube to give you guys better quality content by me buying a sweet microphone, which, by the way, if you guys haven't seen a picture of that, make sure you check it out. All right, now let's take a look at this dividends at the current share price, because, well, Microsoft is a company that people, including me, I like it because of the dividend as well. It's not too shabby, right? Now, with this current share price, I don't necessarily know, right? But let's say that you make the average US income $68,703, bringing this to the monthly, guys, $5,725. If you were to put in 1 month's income into this company, you would nearly get 22 shares. At the current annual dividends per share, this company would pay you back annually $54.53, quarterly of $13.63, and monthly of $4.54. So It's not the best, right? There are better companies out there that you would get a higher dividend for this same amount. But understand that, guys, this is Microsoft, right? You guys just heard my story at the beginning of the video. In 2016, they were $53. Could you imagine buying Microsoft back then? Okay, I understand that their dividend wasn't $2.48, but you got a massive dividend increases throughout the past several years, right? And on top of that, not just with the dividend raises, you also got a massive capital gains as well. So Microsoft is just one of those companies that's just like an overall good company if you're able to buy it at a really, really cheap and really, really solid price tag, right? At the current share price, I don't necessarily know if you consider that. Me personally, I would prefer the 150 to around 180, maybe 190. Maybe I would be willing to pay the premium at 200, but anything above that, it's just not looking that attractive, at least for me. All in all, guys, this is a company that I own. I do own a couple shares of it, and I honestly kick myself every single day I look at this company because I had the opportunity to buy it when it was at $50. And me being dumb, me being 21 years old, didn't know what in the world I was doing, I lost a whole lot of money using options instead of focusing on buying good selling companies and just holding them, right? Again, if you guys haven't seen that video, make sure to check it out. It's called My First Investment Portfolio. Overall, guys, I love Microsoft. If this thing ever fell below $200 again, oh my God, sell a kidney because you only need one to survive at that point, right? Anyways, that pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video. And again, guys, remember to check the community post to vote on which company you guys want to see, and I will prioritize it.